Okay, well, so we'll begin with the balance sheet, and a balance sheet's a statement of the financial condition of the farm. It's a listing of the assets and liabilities of the farm, and who owns the assets. So assets are defined as split up between equity, which is owner-owned assets, and liabilities, which are essentially lender or other owned assets. In other words, liabilities against the total assets. And then the difference of those between those is the net worth or owner equity of the farm. This is what a balance sheet looks like. You'll notice that the balance sheet is separated into categories of current, intermediate, and fixed categories. This is typical of agricultural balance sheets. In the business world, oftentimes it's just current and non-current. The definition of current is those assets and liabilities for 1 year. The definition of intermediate is 1 to 10 years, and the definition of long-term is any asset beyond that. So the intermediate generally classify machinery and livestock under that asset class. Fixed is usually farmland and buildings and improvements, and then current are your assets that can actually be turned into cash without disrupting the operation of the business. So these will be inventories, cash accounts, and such. It's important to remember that there are assets returned that can be cashed out without disrupting the business. So you can't go out and sell your tractor and still operate your business. So that's why they're separated out this way. And then the liabilities match those. The liabilities are matched to the class of assets. In the current liabilities are those liabilities, taxes, accrued interest, and taxes that are due that year. Intermediates would be machinery notes or equipment notes, and long-term would be your buildings and land. The balance sheet, it gives a listing of everything that is owned by the business. Gives a statement of the owner equity at a certain point in time. Like I said, it's like a snapshot of the business at that particular time. The balance sheet is a statement of the classic basic accounting equation: assets equals liabilities plus owner equity. So you just rearrange that, and the owner equity is what's left after you pay off your liabilities against the assets. I'm going to skip through this because I've really got myself up and I somehow sent the wrong one to Colette, so I think I have too much for the amount of time I have. So I might have to skip through this, and if you have a question, and I apologize for this because it's really thrown me off a little bit here. But if the uses of the balance sheet, you can use the balance sheet to measure solvency, which is the relative health of the farm. And that's if you basically cashed everything out in the farm, is the farm solvent? Does the assets of the farm able to meet all the liabilities of the farm? Liquidity, though, measures the ability of the farm to carry on business and meet obligations as they come. So as they come, in particularly cash obligations in the short run, and there's a couple of measures we'll mention that are used to do that. In the world of non-agricultural business, a lot of time these assets are broken up into current assets and non-current assets. with just the current assets being those assets for 1 year and the matching liabilities, and then the non-current assets of past 1 year with the non-current liabilities. The reason why we use the 3 format in agriculture is because they better match our asset classes in agriculture. So the current assets on a balance sheet include cash, accounts receivable, inventories of grain, feed, livestock, supplies. And non-current assets include, as I said, machinery, equipment, buildings, and land. On the liability side of things, current liabilities include the obligations due within 1 year. So that would include the obligations on notes that are due within that current year, plus accounts that are payable, interest and principal on the long-term loans and operating loans, and also accrued expenses. So that would be property and income taxes that are accrued for that year. And I mentioned that this is the more current, or excuse me, more applicable to agriculture, traditional way of breaking up a balance sheet. So the owner equity is what is left after recover the liabilities. The owner equity is the part of the farm that you own as the owner. It's your current investment in the farm. And I'm going to skip that. As far as that, it's one thing we got to pay attention to when we put together a balance sheet is asset valuation. And assets can be evaluated traditionally in accounting terms by cost or market. And cost is more acceptable, but market is frequently used in agriculture. The cost basis is the purchase price minus any depreciation plus any improvements. Or it can be the farm production costs. So for instance, if you are raising livestock and you raise, say, a calf, you take a calf from your operation and move it into your breeding cycle, all the expenses it took to get that calf raised into a heifer, into the breeding part of your operation, that would be the farm production costs. On the market basis, it's the current market value minus the selling costs. A lot of people maintain both, and I work a lot with FinPAC out of the University of Minnesota, and they recommend maintaining both these, at least for intermediate and long-term. There's no reason for short-term. For short-term asset classes, we just maintain just the market basis. But for long-term and medium-term classes, intermediate-term classes of assets, we can maintain both the market value and the cost basis, and they come in handy in different applications and different comparisons of our businesses. For instance, if you only maintain market basis, you could show an increase in equity, which has nothing to do with profitability, only do with changes in market prices. Okay, I'm going to skip that. That's a more detailed. Okay, here we go. So that's the basic use of the balance sheet. I also wanted to mention a couple of measures that we can use on the balance sheet. One of the most important is the current ratio, and the current ratio measures the liquidity of the ability of the business to meet the needs in that current year of operation, that upcoming year of operation. And the way we calculate the current ratio is current assets divided by current liabilities. I've seen this particular ratio miscalculated in several publications, so it's pretty important to get it right because it's used to compare, particularly by lenders, it's used to compare this ratio with other operations and your operation to see whether or not you're essentially liquid for your coming year. So if for example, your current ratio was 1.3, it just means that for every dollar of current liabilities, you have $1.30 of current assets from the balance sheet. And if that ratio is too low, it indicates that you have cash flow problems. Also indicates that any shocks and prices of inventories of crops you have on hand, berries in the freezer in Stan's case, that if you have too low of a ratio, you can be susceptible to risk as far as market risk, prices change or costs change. If you're too high, it can just indicate that you're just holding too much cash. You could put that cash into better use, or your current assets could be put into a higher return situation or a longer term situation, or it could retire some of the debt in the other categories. Another ratio we can use out of the balance sheet is the debt to asset ratio, and you'll commonly see this. You just divide the total assets, total liabilities by the total assets. And if that comes out to say, let's say that came out to 0.7, that would mean for every dollar of asset, 70 cents of that is debt. For every dollar of asset, 70% is debt. If it's just one, it means that assets and debts are exactly equal. Then the final ratio off the balance sheet, and there's several, but this particular of the final three important ones is the debt to equity ratio, and it measures the total liabilities to the total equity. So if you have a 1, that means the debt is equal to owner equity, so basically providing the same. If it equal proportions towards of the assets. If that is less than 1, it means that the majority of the asset funding comes from a lender or debt sources. If it's greater than 1, it means that the majority of the asset financing comes from lenders. Okay, now we're going to turn to the second statement of accrually adjusted income statements, and I think that Barbara has mentioned this both weeks, that the most correct way to run a business is on an accrual accounting system. However, farmers, about 90, I've read estimates that as high as 90% of farmers run their businesses on cash accounting systems, and many of them report their Schedule F on a cash accounting system. Probably the same proportion, up to 90% report on a cash accounting system. The problem with that is a cash accounting system distorts the actual profitability of the farm in that particular accounting period, which usually is a calendar year. So what I suggest, and we've worked with many farmers on, is using the beginning-ending balance sheets to make accrual adjustments to their cash accounting statement, in other words, their income statement, in order to produce a reasonable replacement for an accrual accounting system.